Hey folks, welcome back to Honey Money SG. Today let's talk about a topic called stop saving money for retirement. Now I know what you may be thinking because I always talk about saving money, cutting down your expenses, but now I'm telling you all to stop saving money. I'm crazy, right? But hold on, let me just explain what I'm talking about, because I'm going to talk about how an average person actually save for retirement. So this is what usually happens, right? Assuming that this person wants to retire at the age of 60 and the expected lifespan is up to 90 years old. So this guy needs to plan for 30 years of retirement funds, and assuming that during his retirement years, he wants to live on by a monthly income of $2,000, and that is for his expenses. And also I'm talking about $2,000 in today's value. I'm not accounting for any kind of inflation or interest rate yet. So we are talking about $2,000, and if we sum up the total number of retirement funds, that will be $2,000 multiplied by 12 months multiplied by 30 years, and this will give you a total of $722,000 worth of retirement funds for him to retire. So I think this kind of retirement funds calculation is really straightforward, right? Basically, you are just taking your monthly expense multiplied by the number of months and the number of years that you want to plan for your retirement, and that's why it's just a very simple calculation. But you know, in real life, it's always more difficult than you expect it to be, because the average Joe will always forget about this thing called inflation. Unless you have been living under the rock, then you will know that this year alone in 2022, a lot of the prices and costs have inflated. If you go to hawker centers, many of you have realized that the base price have risen from $3 to at least $3.50 now for a single meal of noodles or rice. And I think everybody by now understand the impact of inflation. So it should be easier for all of you to understand that $2,000, the value of it 10 years later is not the same as $2,000 now due to inflation. Your $2,000 10 years later is very much likely to buy lesser things than what you have right now, because 10 years later your bowl of noodles may have risen up from $3.50 to the base price of $5 right now, and I'm kind of expecting it to happen looking at how things are going right now. So if we were to use simple mathematics, then if we use inflation at a rate of 3% per annum, then 10 years later, your $2,000 will be the same value as $1,488 today, which means your purchasing power actually got decreased by inflation, right? Because despite you having the same number of retirement funds, but everything around in your life, the cost of living has increased due to inflation. So you can never measure $2,000 of today the same value $2,000 10 years later. In fact, 3% inflation is already quite a conservative estimate, because if we look at a recent news report, Singapore's core inflation have risen to 3.6% year over year, which is the fastest growing inflation rate within the last 13 years. So for people who are saving their way to retirement, I don't think you can use it anymore, because you understand the impact of inflation right now, don't you? And what can you do about it then, other than just saving money? I think you need to look at other alternatives to increase your retirement funds. And one of it is to start investing early, right? Especially at a young age of 20s and 30s. I mean, if you actually start early investments, even if you make mistakes, you're bound to recover, because you have a long runway ahead of you, and you can always make all these losses back. Because you're young, you have a very long time period to recoup your losses, as well as adding on to the knowledge and not making the same mistakes that you did when you were younger. There are actually different kind of investments like stocks, like bonds, like crypto, and even real estate. It all depends on what are you familiar with and what are you willing to learn and go and master it. For stocks, you can actually look at dividend stocks when you are older, because these are instruments that can help you generate cash flow when the company actually pays out excess cash as dividends to the shareholders. So every 6 months or every quarter, you can expect to have like an inflow of cash, because the company actually pays out the dividends to you. Then you can use this cash to go and fund your purchases and your daily lifestyle expenses. And if we were to look in the Singapore market, there are a number of stocks like this, right? We have the big three banks, DBS, UOB, OCBC, all paying around 4% dividends at the current price. Which also reminds me that you can use my referral links down below to sign up for stockbrokers like Tiger and Momo, because you can get some free stocks on the way, and before you even start investing, you already make money because all these stocks are really free. You just have to fund a bit of cash and maybe place a few trades to fulfill the terms and conditions. So do use my referral link. So that's for dividend investing when you are older, because I know a lot of you at a younger age, maybe you all want to focus on growth stocks, but maybe at an older age you all may want to switch to more cash flow instruments like this. Next up is of course interest income that comes from borrowings, and one of the borrowings is actually your bonds, right? Singapore savings bond in particular, if you look at the last month yield, it was around 2.71% annualized. And it's super low risk, right, for the government to actually default. That is a very low possibility. So for people who are low risk takers, you may want to add in some of the Singapore savings bonds as part of your retirement funds. Then for people who have a higher risk appetite, maybe you can go for a higher risk bond like Astrea. Recently they launched the Astrea 7 bond, giving you around 4%, which I think is not bad either if you are looking at a bond instrument. But of course, all these are not financial advice. You have to do your own research to see whether it suits you. And then for rental income, is straightforward, right? If you have a property or if you have a spare room that you can actually go and rent it out on the rental market to go and generate some cash flow and rental income to potential tenants, I think that's great either, because once you sign a 1 to 2 years contract, your rental income is kind of guaranteed, right? 99%, provided your tenants pay on time and they don't give you any problems during their stay. Especially HDB. HDB has one of the highest rental yield in Singapore, even more so than condos, because HDB is really affordable. So if you are looking at renting out spare rooms or a spare HDB apartment, then I think just add this into your investment portfolio for real estate. And I'm not even including any kind of capital gains if you actually sell off your property, especially in this very hot property market in year 2022, because when you're older and your kids move out, you can definitely move into a smaller apartment, right? Government has been encouraging the senior citizens to get the 2-bedroom flexi flats because their prices are really affordable, and because it's a smaller place to clean and maintain, maybe it's more suitable for the older folks. Then at the same time, once you have sold away your larger apartment or flat, then you can use it as a retirement fund to go and maybe invest or put in the Singapore savings bond. I think those are good options to go and place your funds. And the alternative of not investing is definitely you can look at something called CPF Life, because I talk about CPF a lot in my channel, and all the CPF knowledge and funds that you have accumulated over the years is just for this day. Because age 65 onwards, you can start to draw on your CPF Life funds that gives you a perpetual annuity until you are no longer in this world. So I think it's a good annuity to have, although it cannot fully cover your daily expenses depending on how much you spend, but it's a good supplement to your retirement income by not investing. So I think everybody should start to look at CPF and CPF Life for a retirement option. So really, I'm not telling you guys to stop saving money, but more of saving money is not the way to retirement. You really do need to have other source of funds, because as the inflationary environment comes up, then you know that your money value is no longer the same money value 10 years later or 20 years later even, which is why looking at investing and also CPF is one of my priorities starting this channel, to really share this kind of knowledge so that you can start preparing for it now instead of when you're turning old and then you regret that you didn't start earlier. And I hope that this has been a good motivation for you guys. But if you really do want to learn about CPF, my strategies and hacks and all the tax relief stuff, then I can refer you to watch my playlist on CPF over here. With that, thank you for watching. My name is Christopher. This is Honey Money SG, steering young adults to financial independence.